All right, well, my name is Gregg Ibendahl. I'm a faculty member here at K-State in the Ag Econ department. Been here about 9 years. I'm originally from Southern Illinois. I grew up on a grain and beef farm there, and I've been a faculty member at Kentucky and Mississippi State and now here. So this is a little closer to home for me than what Mississippi State was. So I really love the Flint Hills. I don't know if I could ever live west of Salina though, because that gets way too dry for me being in Southern Illinois. So I like a little more moisture, a little more trees and stuff growing around. But so I have taken over now. You guys may have noticed if you look at our list of faculty members, ever since this pandemic started, we're down quite a few faculty members. I think probably about 6 or so. So one of the faculty members who left was Michael Taylor, who used to do all the land rental stuff. And she went down to Auburn, I guess, for a better job offer down there. So we needed someone to pick up this area. I picked it up. But before Michael left, she warned me, well, if you're going to pick up this area about cash rental rates, be prepared for a lot of feedback, because this is kind of a touchy subject for a lot of people, depending on whether they agree or disagree with what you guys publish for estimates of cash rental rates. And she was certainly right about that, because how many of you guys have looked at our first publication we published back in July about cash rental rates? Anybody look at that already? No one has seen that, our Ag Manager? Well, maybe that's a good thing, because what I'm going to show today is actually a revision based on what has happened with the NASS survey that came out in August here. So I would encourage you guys, if you want to see these numbers in more detail, go to Ag Manager, look up the specific publication about cash rental rates. You can take a look at what we're suggesting for rental rates. Well, some people have looked at it, and they have called me and Dan several times about various topic considerations about that. Not everyone's been happy about our suggested rental rates, unfortunately. So just keep that in mind, that what we are showing is a suggested starting point, that we're not saying this is the rate that a specific tenant and landlord should be paying. That's just our estimate based for our starting point. It includes things like the soil productivity. It includes, it's the average of the county. So there, even within a county, there will be enough variability from what we show that you can make a case of even going higher or lower than what we're suggesting to start at. So again, this is not an endorsement for what to pay. It's only a starting point. Again, we provide a range from a 25th percentile on the low end up to a 75th percentile on the high end. Really, the rate that you pay could be anywhere within that, and could be even higher or lower depending on maybe some other factors. And then we also have this concept of what is a fair rental rate to pay. Now, to an economist, a fair means something a lot different than probably what the typical person may think of when they think of something being fair. So to an economist, a fair is someplace where I go and my kids take their 4-H project, they go and ride the Ferris wheel, and we have some cotton candy at the end of the day. That's what a fair is to an economist, okay? But if you're talking about in terms of rental rates, well, what's really fair or equitable? And that's really, there's not a set number you have when you say something is fair. It's whatever the tenant and landlord agree to pay, and there's no coercion or any kind of somebody think they're being forced into paying a certain rental rate, okay? So everyone agrees that this is a good rate to pay. I'm not being forced into it, and that's considered to be a fair lease. So what's a fair lease between two sets of parties over here, a tenant and landlord, maybe a totally different number, even within the same county, compared to somebody else when they come up with. And there's several factors that go into that, maybe non-monetarily when you negotiate the lease rates. So maybe if you're a landlord and you've had a tenant farming your ground for the past 20 years and you're very comfortable with them, and they do a lot of things for you, maybe you're willing to have maybe pay a lower rate. I have a perfect example for that, because my cousin, who is currently farming my family farm, he had to put up a lot when my dad was still alive, and basically couldn't be on the farm. My dad was one of these guys, that his whole life was his farm, and he loved to manage the farm even when he had to go to the nursing home and couldn't be on the farm himself. So he would call my tenant like 6 o'clock in the morning when he got up and say, I need you to go do this and this and this for the day. And we try to keep my dad from doing those kind of things. But you guys are probably all familiar with situations like that. Well, my cousin was always a good sport about it, and put up with that, and was able to tolerate that thing and actually help my dad out quite a bit. So we're currently giving my cousin, who's farming our family farm, probably a lower rate than we could get otherwise, just because he had to deal with a lot of those kind of things. The same way, if you're a tenant looking to rent some ground, maybe some ground comes up for rent, right next to you that you've always had your eye on for the past 20 years, and you really want to add that property to your farm base, well, maybe you're willing to pay a higher rate in that kind of situation just because it fits in with your machinery complement it fits in with your location, and you want to add it to your farm base like that. So you're paying a higher amount. But all those things factor into what would be considered a fair rental rate. Again, so whatever you can come up with and both parties agree to without any kind of coercion. Well, why are we producing these publications? Well, first, renting is very important to practically every single farmer out there. If we look at this graph over here, renting in Kansas, you see there's two things going on. The red line is the rent median, which is the amount of land, percent of land that a farmer is renting, if they do rent. And the bottom line is the percent of farms who don't rent any ground at all. And you can see from the bottom line, about 95% of farms in Kansas, well, this is just based on Kansas data, but it would be pretty much the same situation in any state you would look at across the country, that about 95% of your farms are going to rent some farmland. And we'll talk about some of the reasons for that here in a minute here. And I would guess, if I had to take a guess of what this distribution of farms looks like, this very 5% who's not renting, those are probably farmers who are probably older, who are probably thinking about maybe getting out of farming in a few years and just don't want to take on the added risk of having rented farmland here. So a very small subset. The other 95% are renting land, and the amount of land they rent actually amounts to about 70 to 75% of the total farm base. And this is the median amount, so we would have about half of our farms that would be actually above 75%, the other half would be below 75%, but the midpoint would be about 75% of your total farm acreage base. And you're probably thinking, well, you know, if I was a farmer, if I had my druthers, I would rather buy ground than rent it, right? I mean, you get so many more advantages to buying farm ground as far as the control issue is concerned. You know, one thing, if you're buying the ground, you don't have to worry about your landlord calling you and saying, well, when are you gonna come out and harvest my crop, and all those kind of issues go along with things like that. You don't have to worry about renewing your lease in a couple of years or a year, whenever those things come due. So there's a lot of advantages to actually owning farmland. You would think that the percent of land that you would actually control that you own will be a lot higher, but there's some financial reasons behind that we'll go over here in a minute that explain that. The other thing that we're producing these rental rates, so we're actually using a procedure that's going to estimate the rental rate based on the productivity or net farm income potential from that farm ground. That's kind of an unusual approach, because practically all the other data that you see is going to be survey data. NASS does a survey, I think, in practically every farm state, usually sometime over the winter, of what rental rates are in your county. And here in Kansas, and I guess that applies to the rest of the US as well, they publish those rental rate estimates about the end of August, which is a number that actually happened, you know, probably maybe 6 to 8 months ago, or maybe even longer than that here. So there's some time delay in that. And then we have the question about, well, Dan, did we decide that the renters are the ones who are doing the survey that NASS does?
It's very much a renter-oriented survey.
Okay.
Farmer renter
survey. So there may be some incentives if you're the farmer renter reporting your cash rental rates. Well, do you really want to report the true rental rate, and maybe an effort to help keep those rates down, so that when you do go buy, rent more ground, that you can maybe get a lower rate? So we always question about whether we're actually getting truthful responses from producers in those kind of situations, just because there is some incentive to maybe kind of keep those kind of rates down. And then the other issue here is, well, someone asks you what your rental rate is. Are they talking about maybe the land you're going to rent next year? They're talking about a rental contract you already have in place. That's not really clear from the questions here. So I think we get a combination of maybe new ground being rented, and maybe what they're currently paying maybe are on some multi-year leases here. So that may tend to keep the rental rate down as well here. And then I think there is this lack of information about, you know, what it should be based on your productivity and what the potential net farm income is doing here. So I think we're filling in some of the holes that show up there. Here's another example of why the survey data may not be the best when you look at those numbers from NASS. Here is what the NASS numbers for the state average cash rental rate for the state for non-irrigated farmland and irrigated land. And you can see that the non-irrigated cash rent number, it goes up slowly, but we don't really see any big jumps that might match up with what's been happening with net income. Probably more so on the irrigated side. We do see some jumps up when we had some better years, and it kind of diverges from what the non-irrigated side did. If I just had to look at the net income potential per acre for land, I might expect that the rental rate number that's reported back would match up more like this. I would expect to see some higher years like in the early 2010 range where things were really high for net farm income. But that's not really showing up here. You may see a little bit of it over here on the irrigated side, but certainly not on the non-irrigated ground. And then we didn't see anything with the drop off. And right now we're looking at a period of rising net farm income for the last 5 years. Well, not a whole lot of that even showing up here on a non-irrigated side, which makes me question about how accurate those non-irrigated rent numbers that we're getting back from surveys are actually being. And then, you know, for 2021, if you guys go back and look at my publication on Ag Manager about my forecast for net farm income for this current year and for next year, you know, 2021 potentially is going to be probably record net farm income. I'm not sure how bad the drought hurt anything, but I don't think it's going to be enough really to make my forecast be all that different than what I have under Ag Manager here. So we're probably looking at another year where net farm income per acre is bumped up again. Right now, we're not seeing that show up in the survey thing. So again, all these reasons why I think it's good to have a publication that based the cash rental rate on the actual soil productivity and net farm income potential. All right, so here's the reason why you see so many farmers actually cash rent ground or share rent ground as opposed to owning farm ground. It all gets asked the idea that if you go out and purchase farmland, it will never ever cash flow. There's a great article out there in Farm Managers and Rural Appraisers written by Arnie Oatman. It's probably about 20 or 30 years old now, but he makes a good case for why if you go buy farm ground, this thing's never going to cash flow, right? That doesn't mean it's a bad investment though. It's actually a lot of times farmland is going to be a great investment, but you should never expect that farmland to generate enough cash to cover the principal and interest payments. And there's two reasons for that. The first is land is never depreciable, right? That's one of the few assets you buy that actually has a non-depreciation rule attached to it here. So whereas other assets you buy, you can depreciate it, it will generate cash flow back to you that way. Farmland is going to be a case, but that's never going to happen. The second reason is that not only does land not depreciate, but in most cases it appreciates, means it goes up in value every year, probably in the neighborhood of probably 2 to 4%. You guys have probably all heard the expression that farmers are land rich but cash poor. Well, this is the reason for that, is because when you look at buying a piece of farmland, yeah, you're going to get some return from your net farm income, but based on some of the historical numbers that I've seen, about half your return then is going to occur as land appreciation. So you get half your return as net farm income, half as appreciation farmland values. Well, that's great as long as you don't need to sell your farmland, don't need the cash from that. Yeah, you do have an asset now that's worth a lot more and your equity is growing, but you don't see that back in cash that you can actually use to cover the principal and interest payments. So these two things go together are why you see such a high percent of land being rented, because when you do go out and buy ground, then you need to buy so many acres or have so many acres to rent unless you have enough cash already on hand to cover those land that you just purchased, right? So the big percent of rented ground occurs for that very reason. So what's our approach in this whole thing? Again, we talked about some of the problems with the survey results and why you really can't always trust those in all situations. So we're going to look at this process called a tenant's residual method. It's very similar to what Michael Taylor was doing when she did this publication last year and the years before that. She used this concept of a fair lease percent, but it's very similar to this tenant's residual method that we're going to talk about here. What we're doing is we're actually looking at the county yield history and looking at the last 5 years of that. We're looking at recent grain prices, again, looking at this current year and the previous 4 years. And then on the expense side, we're actually looking at KFMA farms to get an idea for that. So that's one of the reasons why I'm at K-State right now is the KFMA farm program. Us and Illinois are really the only two states that have a good set of farm management data, where we have last year we had about 1,000 farms that gave us usable farm data, and we can trace our history of farms back about 45 years, I think. And we actually still have in our system about 5 farms or so that have been in our system the entire 45-year history here. So that's a wonderful data set to have that we can actually trace through and look at what's been happening farms over time here. So that's a good set of data. They actually use that data then to do income tax returns, Schedule S. So from the whole farm perspective, then that data is pretty good here. So we're using that data then to come up with the farm expenses. I'll talk a little bit more about how we break those out to cover different counties. And then what we also want to do, in addition to covering just the cash cost and what you normally would think as fixed costs, which would be like machinery, we're also looking in to cover things like unpaid labor and also some kind of management fee on top of that here. So once you have paid yourself and paid all your expenses, whatever you have left over then is amount of money that you can donate or you can put toward paying for cash rent. So that's the approach that we're doing in our analysis here. And basically what we're doing is, from an economics thing, we're saying we're covering full economic costs by our procedure. All right, well, what are the details of how we're doing this then? So from the income side, we're looking at yields, prices, and government payments. I said we're using our KFMA numbers for the expense side. So we have about 1,000 farms, and unfortunately we don't have farms in every single county, and we're a little thin if we did start separating our data that way. So I'm using the KFMA numbers mainly on the expense side to get the expenses. On the income side, I'm getting yields based on the FSA reported yield numbers for a state and the number of acres that they have. I first was going to use NASS numbers. If you guys have ever been to Quick Stats and looked at the numbers there, those are all for the NASS side of things. The only problem is NASS quit collecting both irrigated and non-irrigated yields about 3 years ago. So I really can't use those now because they lump all of those together here. So looking at a state like Kansas that has a lot of irrigated production here, I can't really use that mixed number here. But luckily FSA has that nicely and separated for us. Again, I can tell the acres, I can tell the yields. So I'm using that for my yield side. From the prices, I'm looking at the state average grain price. I didn't really go into any effort to really look at basis a whole lot on this. And then I'm using about the last 5 years worth of grain price too, which I put a little more weight on the more recent numbers here. So I'm saying kind of the past is a guide for what may happen in the future. But I am including an estimate for 2021 and maybe a little bit of 2022 in there as well. So on the expense side, I'm looking at KFMA data. I said it's really good from the whole farm perspective. What I really needed though is to have that data at an enterprise level, because the enterprise mix does shift quite a bit. This last year in 2021, we saw a big shift out of corn into grain sorghum. So I want to be able to incorporate those kind of things. So I need to convert all that data then into a specific enterprise thing. So I have the whole farm. What I'm using is the state KFMA enterprise summary, and I'm using that allocation between expenses to separate those by farm. So I know, like from our KFMA corn enterprise versus the KFMA soybean enterprise, corn fertilizer expense is about twice what the soybean number was. So I'm basically using that ratio then to allocate those expenses among farms here. So even though a farm may have not had grown a crop, I can still generate a potential crop revenue from that particular farm for that. So that gives me the ability to generate an enterprise level at each particular farm. I still have the difficulty though of I don't have enough farms in every county. How am I going to get a county number? Well, what I'm doing now then is I'm just using an expense level number at the crop reporting district number for every farm within a county within that crop reporting district. So it's not divided by county per se, it's divided by crop reporting district. So I have enough farms to do that with 1,000 farms. I think Southwest is my smallest crop reporting district for farms, but even there I have 30 or so farms that I can use to get an average for the different crop enterprises. And then basically I just take the median point and I generate a crop reporting number for each enterprise in each crop reporting district. In my first iteration of this, I think there was a little bit of issues that when I moved from one crop reporting district to the next one, that it was kind of an abrupt change. So in this last revision that you guys have in your handouts, I have since changed that, and my procedure now is those counties that are bordering a crop reporting district, I'm kind of averaging across those counties within a border to kind of help smooth out my transition from one to the other. I think that helped quite a bit in my current analysis. Some other details. So in the analysis, KFMA also calculates an unpaid labor number in the numbers that we generate from that. I'm using 75% of that number because I figured even with our grain farms, I'm just using grain farms in our analysis, that even then there's about 25% of other activity that needs to be allocated for unpaid labor. So that's why I'm only using 75%. But then I also allow for a 2% management fee based on gross revenue here. So you need to really cover that and pay for yourself. In addition to your unpaid labor, you also have a management charge on top of that. So that's where that 2% comes from. And then here's the weights that I'm using for my estimate here. So you can see this current year has a weight of 20%, even though it is still somewhat of a projection for what net farm income is going to be. The year before was 25%. And then when I get about 4 years ago, then I'm down to about 10% weight here. So again, it's a little bit subjective here. That may change in the future, but I just thought this gave me a fair estimate from where I am right now. Oh, and then the other things I had to do was, so you guys know in Kansas, we have the situation of having fallow, which me from being in Illinois, fallow was a whole different thing to me. I had to spend a little bit of time understanding that. But by the same token, double cropping is very common to me. So I'm having the opposite issue now in the farm management class that I teach. None of my kids from Western Kansas understand double cropping. So I had to spend a lot of time doing that, but yet I'm still kind of getting up to speed on the whole fallow thing here. But luckily from our KFMA data, I can tell the land use percentage based on the number of acres that they have versus how many crop acres that they grow. So I use that relationship to adjust for land use intensity. And then I think the best thing Dan and I have done is we include in our estimates and in the reports this 25th and 75th percentile. So we're not holding ourselves to this is a number you need to start at. It could be anywhere within this range here, and you can still be okay for the negotiation procedure part of things.
And that deals with varying land quality, and
Yeah,
we do
that
have
too,
a lot
yeah.
of variability in parts.
Yeah, so not only is there variation within a county, but because I'm using expenses at the crop reporting district, there's variation there too. So really two sources of variation going on. All right, Dan will take over kind of some more of our background stuff here.
I think you have the.
Okay.
Well, I appreciate the chance to speak with you. KSU does, excuse me, I've got two mics going. We've got to make sure I get both fit. Okay. We do have other surveys that occur out of the Land Use Valuation Office. Zhonghong Li and Leah Sudel do periodic surveys of irrigated, non-irrigated, and pasture land. And of course, they're using that for tax appraisal purposes in the state. They tend to go by crop reporting district, but it offers some information that's of help. So the latest dry land, non-irrigated leasing survey was 2020, so it's pretty helpful. There was an irrigated survey completed in 2017, and we're updating that right now. So we'll probably have that out. Well, we'll have that out just about the time we head off into November, December, and have those key negotiations that happen in January, February with Kansas lease law. So that's our hope anyway. I'm hoping I do. I've got a light on. 1, 2, 3. Are you catching that? A 1, a 2. There is, but let's see here. Let's come over and check this. That's all right.
Yes, you're good to go.
Okay. Yeah, I didn't have the right button flicked on that thing. So, what's that survey? We talked about the USDA NAS surveys and who they deal with. Well, for this survey, there's a fair balance, not completely half and half, but you do have about a little over a third landlords involved, about half renters, 13% mix of both landlords and renters. So by the time you add that and that together, you're at about 50-50, and then some land managers and some other trustees of land. So some balance in that audience that you're surveying. And they get numbers by crop reporting district. And of course, where we're sitting right now in Riley County, we're in the very southwest corner of the Northeast crop reporting district. So you still have this act, even with, as you were dealing with on your numbers, the issue of dealing with borders, you'll see an average for Northeast that probably fits well for somewhere right in there, and another average for Central that fits somewhere about right in there. And you're doing some bridging to get the difference between Dickinson and Riley County, if you're looking for that crop reporting district overall spread. And the main types of leases across these crop reporting districts, you can see as we sit today, we're in the corner of the Northeast district, about 29% crop share, about 50% cash rent. Now, where my office is at, And you just flip that 50% crop share and about 29% cash rent. You are seeing increased usage of flex leases. When we talk about flexible cash leases, and these are being used quite a bit by the well, I guess I can say this safely because I'm about 4 hours drive away from that area. But it can be used as a competitive lever. If someone sets a flex lease and puts the guaranteed rate pretty attractively, then it says, well, anything above that we'll share with that. Well, that can be, like I say, a competitive lever for relative to someone else who is just really is prepared to offer a straight cash lease, and who's probably more able to. There's a scale issue, I think. Larger farms probably have sources of capital around and spread out pieces of land where they're probably more able to absorb that financial risk of sharing going up. Now, figuring out the details are the big challenge, and we'll get at that a little bit. So we do see, in terms of the percentage fixed cash rent, this is across the state for non-irrigated, 88%, but then again, about 12% flexible cash rent coming into play. Most of it's based on some type of a revenue situation. And average rent paid per year. This isn't the base amount, but this is the average paid with these flex rents. Figured off the cash side, 277 reports, sizable number, $57 as a statewide average number. But you look at all fixed cash rents together, all combined, with most of them on revenue basis, yeah, they end up paying on average a few dollars more per acre, or at least they indicated that with these 37 surveys, 27 here for revenue-based mechanism. And if you have a revenue-based mechanism, you're having to come up with an average yield. Some estimate of what the price is might be a USDA price, and probably a price during a certain time frame at a local elevator, at harvest, something like that. So you've got those type of considerations to make. Then you get down, Greg, we have this up there, they report it by crop, but I increasingly I look at that and say, well, yeah. So in essence, it seems like what they do, that in this survey, we're looking at the primary crops, and we look at the incidence of those crops in the surveys, and then take back out of the data what we get per acre. Well, the main leader, and Greg, I think this comes along with and is supportive of what your modeling efforts are showing. You're looking at a lot of what corn does, right? Mm-hmm. So the two biggest payouts for cash rent are the presence of corn acres, the presence of soybean acres. And you take those two out, everything else is in the 30s and 40s, maybe mid 40s, 65, 78. So if there's soybeans in there, then you've got a strong central and eastern Kansas component on non-irrigated. It is what it is. Excuse me. We do have some, we have some other numbers here. You see there's something to see here. The number of reports, 314, the overall state average, 5770. Flexible cash rent, the overall payment, again, there's about a $4 differential in terms of a little bit more money paid out at the end of it all, into the calculations under the flexible cash rents than the average rents. And I think this one we've already, okay, this is average cash rent payment per crop reporting district. Okay. So we're sitting here in the Northeast crop reporting district, and this isn't your model that said this, okay? Your model didn't say this. I think people see this, they say that Ibendahl's model. No, they say O'Brien and Ibendahl's model, put that number up there. But Northeast average, 109. Well, Brown County, some of those counties to the north, some very, very good land up in there. So that's, you're affecting that. That compares with, well, here's North Central at 91, the average at 16 observations. That Northeast one had 46, East Central 64, Southeast a little bit less. That same north to south, gradient lower, Northwest, West Central, Southwest for average rent, North Central, Central, South Central also. So we have, maybe it's just the closer to Nebraska we are, the more we pay cash rent. That there's more to it than that, but they do pay high cash rents in Nebraska for a number of reasons, land quality and high taxes. And you can see these, so let's say Northeast, we're 109 in Northeast, and the average base for flex cash rent is about 92. If you look at that same situation in let's say Southwest Kansas, 32 base, and then, oh, pardon me, that I'm saying the wrong thing. The flexible cash rent total payment amount paid 90, say North Central 91, we end up and paid 105 there, 109, they ended up and paid 95 on the other. So some of those numbers I need to look at closer, but that's how the survey came out. Okay, importance of different factors. This is a whole lot of numbers that says basically that price and land quality are the two most important factors that people are looking at as they figure out their the rental rates. You do have the relationship between landowner and tenant. I'm going to make the statement that probably I think it holds true, but probably gets you in trouble with some that there are things that happen in family leases that wouldn't happen in the open market because grandma or whoever is just being kind to this poor family over here. They're trying to get going, you know. But if it's on the open market, what's the rate? They still might be kind to them. There's a little bit of irrationality that can enter into family leasing arrangements, you know. So I'll just make that statement. And yeah, I think we've seen this one already. I do want to look at some of the other leasing sources of information that are available in the state. Now, if you're in Northwest Kansas, North Central Kansas, Northeast Kansas, then when you get a question about what cash rental rates are here in our areas, you do have a southern Nebraska border effect. Again, they pay sizable. I'm involved with a family farm, small amount, my small part in Fillmore County, and you know, rates. Well, they've basically in my lifetime they've doubled. You know, for 70 some acres of the whopping 74 acres non-irrigated cropland, we used to pay about $1,000 an acre. Now it's about $2,000, $2,500, just state tax rates. You know, just expensive. So you see non-irrigated. Again, we're focusing on the Southwest, South, and Southeast. The average in Southwest Nebraska, $42 an acre. If you go back and look at what we had for Northwest Nebraska, Northwest Kansas, not too dissimilar, but they had a high third and a low third of 35 and 54. So for really good comparison, Greg, when you come up with your crop reporting district numbers, your 75-25 isn't far off of what we're seeing there. South, BR, North Central, 83 average. I think it was 91, what we saw in North Central, but a range of 57 to 120. Southeast, 170. And I think we had, pardon me, was it one? I think it was 109 for non-irrigated, I believe. So, and that's within that range of one. Well, they're just strong there, 135 to 195. Average cash rent by yeah. When you're comparing, when we switch over and look at irrigated payments, the last survey we had is 2017. And again, we're updating that right now. And hopefully by December, January, we'll have have new numbers. So this was 4 years ago. There's been a whole lot happening in ups and downs in grain markets since then. But Northwest, $137. You're probably more concerned about Central and North Central Kansas, 135, 126 for cash rental rates 4 years ago. Minimums, maximums, 185 to 200. So in trying to figure out, well, what could inflation have done to those if we just followed inflation? The Kansas irrigated farmland values increased 27%, the official statewide number from 2017 to 2021. So if you add that 27% on there, and I'm not saying this is an absolute hard rule, but if you add the 27% to kind of follow the trend in land values, then you're looking at what was 135 in North Central, 171, Central, 120 is now 161 for irrigated, and statewide from 115 to 146. The top end numbers, when we look at the Nebraska numbers, you want to remember these. So here, Northwest Kansas, 254 would be where we'd be at North Central, 235. So you come over and look at what's happened in Nebraska. So there's Southwest, 195, a range of 165 to 135. This survey is done of farm managers and rural appraisers. Now, this would be like a farm management group that those people that get involved in that part of those transactions. South 235, Southeast 280. Take one step back. So here we looked at, well, for direct comparison, 171, 235, and there at South, looking at, there's that. We're not trying to mess up the numbers just to come out, but it does come out pretty close. And this is just put this up here. We're not talking about pasture and cow-calf pairs today, but you get questions just like we do about, well, what should I charge for a cow-calf pair? Well, at least this is an annual survey that gives you some more information to look at. You can see it Southwest, South, Southeast, what the average per cow-calf pair is and what the range is too. So that's I always find this under Cornhusker economics, farmland leasing, farmland values and leasing arrangements, and comes out each March 1st. Greg?
Okay. Well, now I'm going to give you guys some numbers. So the numbers you guys have in your handouts for the non-irrigated will match up with what I'm showing here. The irrigated numbers, if I show those here in a minute, I have changed those. So I'm going to send Rich my updated slides, and you want to update those. So the dry lands, though, non-irrigated numbers will match. So here's the NASS numbers, basically, that came out here about a month ago, end of August. This is their reported survey results. Again, this survey probably happened sometime last winter sometime. And this is kind of what I would typically expect as far as the way the distribution is associated. So, our highest rent is up here like at 178, and we get to Southwest Kansas, we're down to about 37.5. And the transition is kind of like what you would expect. We see higher rental rates for dry land ground here in the Northeast, and it tapers off as you go down. Now, the numbers I'm going to show you, again, this is the survey results. I'm going to show you here in a second our estimated numbers for 2022. There's going to be more variation than what you're seeing here. So here's our estimate for 2022 based on soil productivity. Again, this is really the starting point for lease negotiations. You can see similar kind of patterns here. Again, we have the highest rental numbers up here. It'd be 215, and our lowest out here in Southwest at about $38. Again, this should be in your handouts too. But one thing you will notice here, it's not quite the smooth transition like you saw with the NASS numbers. So here it's pretty much smooth all the way down. Here we see more jumping up, and you'll notice here in the Northwest, there's some higher cash rents out here than there is like in North Central Kansas, which kind of surprised me a lot. I think I helped this to some degree by going through and averaging the counties along a crop reporting district border to help with the expenses there. But even after doing that, you notice there's still kind of some abrupt changes. You go from the counties here down to here, and especially when you consider what's going on there. And then my next question was, okay, if I did my best to smooth out the expenses, which I think I have, what's happening on the revenue side that would cause this change, kind of abrupt change as we go from some counties to the next one? And I think I may have discovered that by looking at the number of crop acres of a specific crop growing, and with the key being how many corn acres are we growing in a county? Well, first of all, where do you guys think our biggest county in Kansas for growing corn was in 2020? How many people think it's somewhere out in the eastern third of the state? How many think in the central part of the state?
Are you talking acres or bushels?
Oh, acre. Yeah, I'm talking about acres right now. How about western Kansas? Anybody think western Kansas? Okay, guys are actually correct about that. Our number one county for producing, this is non-irrigated corn, by the way, this is Thomas County. About 230,000 acres of non-irrigated corn in northwest Kansas. I was totally shocked by that. I thought for sure it'd be somewhere in here, but it's really not. In fact, if you look at this on a percent basis, look how much corn we're growing out here in northwest Kansas in 2020. We're at over the 60% of the dryland acres went to corn in 2020. That's something I would expect to see in Illinois. That's not something I would expect to see in Kansas. Now, it's dropped off a little bit this year. I think there's some more acres moved over to sorghum, but in 2020, we grew a heck of a lot of non-irrigated corn acres. In fact, in Thomas County, if you went back and added the 230,000 acres of non-irrigated, there was also 70,000 acres of irrigated corn. We had about 300,000 acres of corn in Thomas County in 2020. That's a lot of corn being grown out there. But notice this big section here in kind of south central Kansas where the corn acres are really low. This is kind of our wheat basket right now in Kansas, is this section right through here. This is where the majority of our wheat's been growing. This is moved to more of a corn sorghum type area here. And that makes me question, okay, well, if you can grow a lot of corn here, why can't you grow a lot of corn here? Now, again, I'm not from Kansas at all. I'm from Illinois here, but I haven't spent all that much time in western Kansas. But is there that much differentiation between the counties that you can grow 60% of your ground here in corn, whereas down here you can only grow 9%? It makes me think, have these farmers up here figured out that it's worth taking on extra risk? You know, it's certainly more risky, but I got a lot higher return otherwise. I think that's what's driving my thing about the revenue.
Just as you head south, that your evapotranspiration really in the summer really moves higher. So a little more grain sorghum and what corn they do grow, they have a lot more split center pivots down there just to survive the hot summers.
Okay, so keep that in mind here. I think in certain counties here, the choice of crop acres and the mix of crops are growing has really affected the net farm income potential, with the idea maybe that a little more risk actually has paid off in a lot of these years here. So keep that in mind too, that we're looking at the soil productivity. So we're looking at what farmers are currently doing within the county. To me, it says that maybe in some of these counties, maybe there is the potential to take on a little more risk and increase your net returns here. So something to think about in this whole lease negotiation about what's the crop mix being growing in the county. Is that really the best mix for particular farms out there? So again, this is in your handout, so you have this one. Now we're going to move to the irrigation side of things. And what we do for the irrigation, very similar process to the dryland irrigation, or I mean to the non-irrigated stuff. The only difference is we assume that you're growing corn on your irrigated ground, and we assume that landlords owned all the irrigation equipment. So that's not the case. And I got a couple of calls already where the landlord was wanting to rinse some ground out. The tenant was wanting to come through and replace the irrigation equipment, and they were going to pick that up. Well, if that's the case, you need to adjust by whatever that equipment costs. Now, again, this is based on buying new equipment and amortizing it over the course of 20 or 30 years or whatever we put in for this. If, as Dan points out, if you buy used equipment someplace, it may not be quite that number that we're showing here.
And I think your calculations, when you see western versus central Kansas, that's a well depth issue, isn't it?
Yeah, that's it. Well, a deeper well, yes.
A lot deeper out west.
Yeah. So if the tenant's picking up any of this stuff here, especially with the center pivot or power unit, then you would need to lower our stated number by these amounts over here to account for those kind of things. So just keep that in mind in the whole process of looking at our suggested starting point number.
That center pivot's about $100,000 or 90 to 100,000, and you may be able to buy a refurbished one for half that.
Yeah, and some counties may not even have center pivot too. So here is the NASS reported numbers again that came out end of August, just like the non-irrigated ones did. You can see there's a lot of counties here you think have irrigation, and they do, but there wasn't enough survey results for them to include that number in their estimate. I'm not sure. Do you know what the estimate, how many numbers they have to have, Dan, or anything about when they do these surveys? But there is a certain minimum number that they have to report that. So that's why, you know, there's irrigation here, but it's not reported. So I didn't have that limitation when I was looking at in my calculation, because I could basically look at the FSA numbers. I could look at how many, I know how many irrigated crop acres there were. So, and I was able to calculate a cost per irrigated corn, even in those counties for those farms I didn't have anything for. So I was able to actually fill in a lot of the missing parts, as you see here, with this particular number right here. So this particular chart is different than what's in your handout. I will give Rich the updated one. This has incorporated our most recent calculations from 2021 from NASS and with my new modified procedures. Now you can see what the suggested starting point for irrigated numbers is going to be. And again, I do fill in a lot of missing blanks, but again, I think I'm fairly higher than what you're seeing from the NASS numbers here, which would indicate better prices or whatever, maybe not quite so much of a lag that the NASS numbers are showing. Again, this number will be in our upcoming publication for irrigated ground. Again, we have the dry land one already out. I anticipate this publication probably coming out within the next week or so. I just need to update some of the text to it, but this will be from the upcoming publication. We'll have the counties. It will have our KSU estimated starting point lease negotiation, as long as the last 2 years of NASS survey results in this.
And if I can just add in, this is where having me as a partner is really a problem for you, you know, in that, and we talked about this yesterday in Garden City on the irrigated numbers. You're using well-constructed several year averages to give people a fair view of where things are at. Yet we have so much inflation right now with tight input costs that our multi-year average, even with weights for that last year, may have a challenge representing the actual net returns to land. What's your thoughts on that?
Yeah, that very well could be not only the price inflation, but whether you can even get some of the inputs you even need. I mean, some of these things coming in from overseas, you know, supply issues and stuff like that. That's going to be a factor going forward for sure.
So that's all. I think we'll just have to watch that. If we get into November and we've seen 80% increase or more for some of these key inputs, then I just would wonder about an addendum on this just to see what's left. You know, for net.
Well, I certainly built some inflation in there quite a bit already here. I don't know if I incorporate all of it, but I think I got a good handle on that anyway.
Sure.
So this particular table will be in the upcoming irrigated publication. Again, look for that coming out on Ag Manager probably within the next week or so.